A new US-China trade deal is making headlines, but does it actually shift the global economic landscape or just maintain the status quo? Meanwhile, US inflation comes in cooler than expected again, fueling market bets the Fed could cut rates twice this year, and that could have major implications for Australia's RBA, with crude oil surging, Treasury auctions calming debt worries, and ASX futures pointing to a strong open. Investors are now gearing up for a volatile yet opportunity-filled trading day. It has been a big week for the ASX as well. To break it all down, we're joined by David Scutt from StoneX. Great to see you, sir. The latest US-China trade pact, does it actually change anything? We hear about a framework, but it isn't exciting the markets.
G'day, Aaron. Great to be back. Yes, look, the art of distraction is probably how I'd go and describe it. What it really does is just take us back to where we were with the Paris Accord. You remember when they went and met about a month or so ago, the two sides. All we've done is make an agreement for 6 months on rare earths, some parts when it comes to chips, and in return, the ability for Chinese students to go and study in the United States. That's pretty much where we were at the end of Paris. And the concerning thing as well is that there's no further plans to go and talk. So what's going to happen next? And I'm not surprised the markets had a really underwhelming response to it. It just leaves us back where we were.
Let's talk about US inflation, that report coming in cold again. Why, and do you think it will continue?
Yeah, this was the really big surprise that happened overnight session, was that we saw inflation in the United States when really undershot both at the headline and core reading. Now, this was for May. So May was expected to be the first month where we really started to go and see solid pass-through of these high import tariff rates. But simply, we did not go and see that, apart from some select groups like toys and heavy equipment like. So what's happened, we saw a 0.1% increase in headline inflation. It was expected to be 0.2. And the core reading, which is far more important, printed at 0.1% month on month as well. They were expecting 0.3. And when you strip out some of the components, it's clear that if you remove housing from that, so the shelter cost is the biggest component in the CPI basket in the States, it's very weak, the inflationary polls, which says something more about what's going on in the economy, I think, rather than on the tariff front.
Yeah, let's talk about the markets and I guess how the Fed is looking at things at the moment. And I guess the markets now see the Fed cutting twice this year. They were expecting 4 last year. That didn't quite happen. Talk about the risks skewing towards it having to do more. What does it actually mean as well for us in Australia and the decisions that the RBA need to make?
Yeah, absolutely. First and foremost, that screen, the chart you've had up on your screen there is basically looking at inflation surprises. It's produced by Citigroup, and it basically is showing that the undershoot on inflation readings at the moment relative to expectations is sitting at levels that we've not seen in over a decade. So that's important for the Fed. And what we saw last night post the inflation report was that markets went and added around about 6 or 7 basis points to pricing. So now 2 cuts are priced in. But when you go back and you have a look at what was coming last Friday out of that jobs report in the States, the headline figures were good. But when you go and take into account downward revisions, when you take into account big losses in full-time jobs and a decline in participation, there's some evidence starting to build now that the US economy is softening and potentially softening a bit quicker than people expected. So that means that the Fed might be skewing towards having to go and do more than 2 cuts this year. For the RBA, that will go and take pressure off them to go and keep rates steady. And it's pretty clear that they're in a mood to go and keep cutting rates at this point in time. So I still expect that they will go and cut at each of the next 2 meetings, conditional on what happens, of course, in the global economy.
And US debt concerns, I guess, ebbing for the moment following another strong Treasury auction overnight. Talk to us about that.
Yeah, there was a $39 billion worth of 10-year Treasury notes that was auctioned at. And so what we saw was that there was a big market reaction. So you can see all those red lines there. It's just pointing to what we saw across the US yield curve. So short-dated yields all the way out to 30-year yields saw decline to around about 10 basis points or more from the session high. So that's a pretty chunky move. And what we saw was that there was good, strong demand again coming through, including from foreign sources for that US debt. So the concerns that were really acute back in May seem to have gone and dispelled a little bit for the time being. But of course, we keep watching that big, beautiful bill and its navigation through Congress. If that gets up, then we'll see what happens with the other bond market. But for the time being, Treasury markets are pretty calm.
Let's talk about crude oil. It's higher again. Bad news for motorists, maybe bad news for the economy as well.
Yeah, in all intensive purposes, crude oil now is back in a bull market. We've had more than a 20% bounce from the recent lows. And yes, there was headlines there about geopolitical tensions. Of course, there was also some talk about a potential draw that was a bit larger than expected in US crude inventories. But if you look at the actual charting of what's been going on, a lot of technical factors probably explain what's going on. And the real interesting thing that we've seen in crude recently, despite OPEC Plus boosting output, what we're seeing is prices have rallied. It's really counterintuitive to what you expect. And it suggests that maybe, just maybe, we've seen the bottom for crude, which means, unfortunately, for motorists around the world, including here in Australia, that we could be looking at higher prices at the bowser.
And good news for President Putin. Obviously, when oil goes up, they always say that his administration's in trouble when it drops below 70 USD. Interesting as well, because, I mean, petrol prices have been jumping around since COVID. 1 minute they're $2.20, the next minute they're $1.60. I think I saw it at $1.49 recently in Melbourne, which is just unheard of. But Australians did not want the 25 cent off Peter Dutton petrol thing, so we'll just wait to see what happens from here. David Scott, appreciate your time as always. Thank you.
Always great to be here, mate. Take care.